Consider every losing position in your portfolio right now. The rational move, the one your own analysis probably supports, is to sell. Cut the loss. Redeploy the capital. You know this. The position sits there anyway, month after month. This is not a discipline problem. Research identifies it as something far more precise, a neurological bias that activates the moment you take ownership of anything, and systematically distorts its perceived value from that point forward. The bias has a name. It has a mechanism. And understanding it may be the most practically useful thing behavioral science has produced for investors. In 1980, economist Richard Thaler published an observation that would become foundational to behavioral economics. People consistently overvalue items they own compared to identical items they do not own. Not slightly. Not occasionally. Consistently, and in controlled conditions. The act of ownership itself, not the item's quality, not its market price, not its utility, changes how the brain prices it. Thaler called this the endowment effect. 4 decades of research since have confirmed that finding, extended it across domains, and traced it from behavioral experiments into neuroimaging suites. What the evidence reveals is a mechanism that operates systematically, that persists even among trained finance professionals, and that is directly implicated in one of the most costly patterns in investing, the refusal to exit positions that no longer deserve to be held. This is not a story about unsophisticated people making emotional mistakes. The studies involve economists, controlled laboratory conditions, and financial professionals with explicit knowledge of cognitive biases. The endowment effect does not discriminate by expertise. That is precisely what makes it worth understanding. To understand why the endowment effect exists, you need to trace it to its biological source. Neuroimaging research by Knudsen and Peterson, published in 2005, identified the specific neural structures that activate during the endowment effect. Their finding was significant. Ownership is not a purely cognitive state. When the endowment effect operates, researchers found measurable activity in brain regions associated with emotion, motivation, and decision-making, most notably the nucleus accumbens and the prefrontal cortex. The authors concluded that the endowment effect is related to the neural representation of value and loss aversion. B-roll CUE, MRI brain scan visualization, neural activity imaging. The nucleus accumbens is a structure you will recognize from research on reward and anticipation. It also plays a documented role in how the brain processes potential losses. The prefrontal cortex governs executive decision-making. What the imaging suggested is that these two systems, working together, are doing something specific when you hold an asset and contemplate selling it. They are not evaluating the asset's present market value in isolation. They are encoding the potential sale as a loss event. This connects directly to the theoretical framework that preceded the imaging by more than 2 decades. In 1979, Kahneman and Tversky published their work on prospect theory, among the most replicated frameworks in behavioral science. Their central finding was that people's subjective evaluation of losses and gains is fundamentally asymmetric. The brain does not treat a potential loss of $100 and a potential gain of $100 as equivalent. Research in this area indicates that losses loom significantly larger in the brain's evaluative system than equivalent gains, a pattern Kahneman and Tversky demonstrated with substantial experimental evidence. Graphic, asymmetric curve showing loss aversion, gains on one side, losses weighted more heavily on the other. What ownership does, according to the combined evidence, is activate this asymmetry before any transaction has occurred. The moment you hold something, the brain has already begun framing any potential sale not as a neutral exchange, but as a loss that has not happened yet. Knudsen and Peterson's neuroimaging suggests this is happening at the level of specific brain structures, not merely an abstract deliberation. You are not calculating whether the asset deserves its current price. Part of your brain is already defending you against a perceived threat. The most precisely designed empirical evidence for the endowment effect comes from a series of experiments by Kahneman, Netsch, and Thaler, published in 1990. The methodology was straightforward. Participants were randomly assigned to one of 2 groups. One group was given an ordinary object, in the most well-known version of the experiment, a coffee mug. The other group received nothing. Those who received a mug were asked the minimum price they would accept to sell it. Those without a mug were asked the maximum they would pay to acquire one. B-roll series, coffee mug on wooden desk, close-up, neutral background. The gap between the two sets of prices was consistent and substantial. Sellers consistently demanded significantly higher prices for the mugs than buyers were willing to pay. Both groups had the same information. Both groups had just encountered the same object. The only variable was ownership, and ownership changed the valuation. Kahneman, Netsch, and Thaler were simultaneously testing a foundational principle of economic theory called the Coase theorem, which predicts that in the absence of transaction costs, goods will flow toward whoever values them most, regardless of initial allocation. The endowment effect directly undermined this prediction. The researchers found that the Coase theorem does not always hold, precisely because ownership generates a valuation premium that the theorem's assumptions do not account for. The market was failing to clear efficiently not because of information gaps, but because of a neurological artifact of possession. Unexpected stat: the endowment effect has since been replicated across a wide range of objects, populations, and controlled conditions, making it one of the most robust findings in behavioral economics. Critically, Kahneman, Netsch, and Thaler confirmed that the endowment effect is observed in various domains, including financial assets. This was not a peculiarity of consumer psychology, or an artifact of people being attached to physical objects. The same pattern appears in markets. The mug experiment was a controlled window into a bias that operates wherever ownership exists, including in the valuation of financial positions you hold today. Everything examined so far, the neural architecture, the experimental evidence, the valuation asymmetry, is academically interesting. But the reason it warrants serious attention is what happens when this mechanism operates inside financial markets, across real positions, held over real time. Schefrin and Statman documented that consequence in 1985. And the pattern they described is almost certainly visible in your own investment history, whether you have recognized it as such or not. In 1985, Schefrin and Statman identified what they called the disposition effect, the documented tendency for investors to hold losing positions significantly longer than warranted, while selling winning positions too early. The pattern is the inverse of rational portfolio management. Winners get trimmed. Losers accumulate. And the endowment effect is a core mechanism driving it. Schefrin and Statman found that the endowment effect can lead directly to suboptimal decision-making in financial contexts, specifically, holding onto a stock that is no longer performing well, or selling a stock that is still performing well. The framing they offered makes the mechanism visible. Selling a winner produces a realized gain, which the brain processes as a positive outcome. Selling a loser requires converting a paper loss into a confirmed, permanent one. Under prospect theory, that conversion is experienced as a genuine loss event, not merely a number changing in a spreadsheet. B-roll series, trader watching declining stock price, reluctant to act. The result is a systematic bias in exit timing that operates in the opposite direction of sound strategy. The positions most likely to be held are the ones least deserving of continued capital. The positions most likely to be sold are the ones still generating returns. Strahlovitz and Lowenstein's 1998 research added a layer to this that is particularly relevant for long-term investors. They found that the endowment effect becomes more pronounced for items of high personal significance, including items with a long history of ownership. A stock you have held for 15 years is not, neurologically, just a financial instrument. It has accumulated emotional weight. The history of ownership itself amplifies the effect. The longer you have held something, the stronger the bias toward retaining it, irrespective of its current merit. The standard financial advice for managing emotional investing runs along predictable lines: be rational, detach from your positions, think like a machine. This advice is not merely insufficient. It misunderstands the biology it is trying to address. The endowment effect does not arise from a failure of intelligence or a deficit of financial knowledge. It arises from a neural architecture that was not designed for liquid capital markets. You cannot override the nucleus accumbens through willpower. The mechanism that Knudsen and Peterson identified in their neuroimaging research is not a cognitive error that careful thinking can bypass in real time. It is a valuation process happening at a level that deliberate reasoning reaches only after the fact. Camera change. Conventional wisdom also tends to treat the endowment effect as something that separates unsophisticated investors from educated ones. The research does not support this framing. Kahneman, Netsch, and Thaler ran their experiments with economics students and people with explicit knowledge of the bias. The effect persisted. Knowing the name of a cognitive bias does not reliably prevent it from operating. Awareness is a starting condition. It is not a solution. The third error in conventional advice is the belief that more information and better analysis solve the problem. They do not, because the problem is not a lack of information. Schefrin and Statman's investors were not holding their losers because they had insufficient data. They were holding them because the act of selling required their brains to register a confirmed loss. No amount of additional analysis changes that neurological reality. What changes it are specific, structural interventions that the research has actually tested. 3 lines of research converge on interventions that have shown measurable effects on the endowment effect. These are not motivational suggestions. They are structural adjustments derived from experimental findings. The first comes from Lerner, Small, and Lowenstein, whose 2004 research found that the endowment effect is reduced when people are given time to reflect on their decisions before acting. The mechanism is meaningful. The researchers found that emotions play a significant role in economic decision-making, and that positive emotions can actually increase the endowment effect, while the deliberative process appears to reduce its influence. The practical implication is architectural. Build a mandatory gap between the moment you identify a reason to exit a position and the moment you execute. The analysis and the transaction should not happen in the same session. The emotional activation that Knudsen and Peterson's neuroimaging identify needs time to decay before the decision is made. Birol CUE, person pausing, writing in a notebook, deliberate reflection. The second intervention comes from Simonson and Drolle's 2004 research, which found the endowment effect can be mitigated by providing market value information about the item in question. The mechanism is anchoring. An external reference price competes with the internally generated ownership premium. For a financial position, this translates to a specific discipline. Before you evaluate any asset you currently hold, determine what it would cost you to enter that position from zero today. Not what you originally paid. Not what it was worth at peak. What it is worth to someone who has no ownership history with it. The gap between your valuation and theirs is diagnostic. If you would not buy it today at the current price, the question of whether to continue holding it deserves honest examination. Graphic, 2-column comparison, current holder's valuation versus fresh buyer's valuation. The third structural insight derives from Strahlevitz's and Lowenstein's finding that ownership duration amplifies the effect. Long-held positions carry a higher endowment effect risk than recently acquired ones, not because of their financial characteristics, but because of their psychological history. A rigorous investor treats the age of a position as a variable that requires proportionally more deliberate process to evaluate fairly. The longer you have held something, the more structured the review needs to be. The endowment effect is not a character defect. It is the predictable output of a neural system documented across decades of research, from Thaler's original 1980 observation, through the controlled experiments of Kahneman, Netsch, and Thaler, through Schefrin and Statman's financial market evidence, and into the neuroimaging work of Knudsen and Peterson. What the research collectively shows is that the moment you take ownership of an asset, your brain begins generating a valuation premium for it, a premium disconnected from market reality, amplified by emotional significance, and intensified over time. This is not something that analytical rigor neutralizes automatically. It is something that requires specific structural responses, deliberation gaps, external market anchoring, and heightened scrutiny for long-held positions. Kahneman and Tversky's prospect theory gave us the theoretical architecture. The neuroimaging research located it in the brain. The financial market studies confirmed the cost. The question the evidence leaves you with is not whether this mechanism operates in you. Research suggests it operates in nearly everyone who holds assets. The question is whether the positions in your portfolio are being evaluated on their actual merits, or on the accumulated weight of ownership.